The Peter Schiff Show.
We had a very big day in the financial markets today with really some significant moves in all sorts of asset classes. Starting with the U.S. stock market, all of the major U.S. stock market indexes were down on the day. The biggest loser being the NASDAQ. That was down 1.9%. I think near its lows, it was down about 2.2%. So we did get a little bit of a rally into the close, but all the indexes were down. But internally, there was a bit of a sector rotation out of the momentum names into the more defensive value names. And this potentially could be the beginning of a long overdue reallocation in the market. So we'll see what happens next week if that continues. But, the bigger moves or more significantly in the bond market, bond yields falling to all-time record lows. In fact, the yield on the 30-year is now below 2%. It's at 1.918. And I think this is an all-time record low yield for the 30-year bond. And of course, the U.S. stock market would be much weaker. And today would have been a much bigger down day, but for the rise in the bond market, which is helping to support the valuation of U.S. stocks, right? Because the lower interest rates are, the higher everybody can pretend the fair value is for the U.S. stock market. And of course, a lot of this is being driven by the supposed safe haven buying in treasuries. But again, all the liquidity that is being supplied by foreign central banks and liquidity that people expect to be supplied by the U.S. central banks. But for that, the U.S. stock market would be much, much weaker. It would have been down a lot more, not only on the day, but on the week. I mean, the markets were down on the week, but up until today, the NASDAQ, at least, that was still positive on the week. And I think so maybe were the other indexes. But the move is very significant in the bond market. And in fact, on CNBC, Bullard from the Fed was interviewed. And specifically, he was asked about rate cuts and, how is it that rate cuts are going to cure coronavirus, right? Which is, of course, what I titled a recent podcast, that QE is not going to cure the coronavirus, which it's not. I mean, that's the only cure the Fed has or any central banks have is just print money, create inflation. But how is that going to work? Because even on this discussion on CNBC, they correctly pointed out that, wait a minute, the problem here is supply, that the Chinese, due to this virus, there may be less production, and America imports a lot of consumer goods from China. And so if these goods are not showing up at the market, isn't that a supply problem? And how does just printing money solve that problem? And, he had to admit that, well, technically it doesn't solve it. But he says that maybe it helps with the symptoms, but it doesn't. Because if the symptom is a reduction in supply, how does increasing demand for items that are in short supply do any good? Because that's all the Fed is able to do is stoke demand, right? By printing money. People now have more money to go and buy products that don't exist, that didn't show up. But in fact, I think somebody on that panel actually asked a sensible question or made a sensible point by talking about the Arab oil embargo in the 1970s, right? That was a supply shock where all of a sudden we didn't get as much oil. And the Fed made the mistake back then of addressing that by printing even more money when, of course, part of the reason for the embargo was we went off the gold standard and the dollar kept losing value. And so OPEC nations didn't want to sell us oil for paper. I mean, we used to pay them gold and then we started paying them paper and paper was falling. But the Fed at the time looked at the negative economic effects of a big jump in oil prices and said, oh, let's print money. And look how that turned out with the stagflation of the 1970s. So if China is a major supplier of consumer goods to the United States and all of a sudden those consumer goods are not here, then why would printing money now in this environment work any differently than printing it back in the 1970s? And they even read a note that Peter Bookbar put out, who's, one of the best people that actually shows up on CNBC with any regular basis. In fact, I think he is a contributor. And, I know him. I mean, I've met him on many occasions because he has spoken at many of the conferences that I regularly speak at. So he's a pretty good guy as far as, the guests that they allow on CNBC. And he put out a note, which they read, which pretty much is what I'm saying, and that what's happening right now with the coronavirus is inflationary, right? It means that the supply of good goes down. And of course, if the Fed is creating more money, that just throws gasoline on the fire. But people are responding to what the Fed is doing by buying financial assets, particularly they're buying bonds. And there was a separate panel on CNBC today discussing the bond market, right? There's a whole bunch of guys up there, and they were questioning whether or not the bond market was a bubble, right? I mean, here you have an all-time record high price for bonds. In fact, the yield on the 30-year bond at 1.9 is well below the government's own inflation measure. The CPI, is 2 point something, right? 2.3, 2.4, whatever it is, right? The headline CPI. That number is higher than the yield on U.S. Treasuries. And of course, if you buy U.S. Treasuries in a taxable account, that yield is going to be reduced even further because you're going to pay taxes on it. But the problem is the yield is lower than the inflation rate. And that's the official inflation rate, which in my opinion, dramatically understates the real inflation rate. But even if you forget about that and just accept the government's word for what inflation is, the yield on U.S. Treasuries is negative. At the same time, the U.S. Financial house has never been in worse shape, right? The national debt is 23 trillion and rising rapidly with no end in sight and no appetite in Washington, either from the Democrats or the Republicans, to do anything about it, right? So there is no plan, or nobody is even pretending to have a plan to bring the deficits down. It's nobody cares. So the fiscal situation has never been this bad. So in other words, the United States has never been less creditworthy than it is right now because we have more debt than ever before, and the future trajectory of that debt is going to skyrocket, and nobody gives a damn or is even pretending to give a damn. So the question is, if you have the lowest yields in history on U.S. Treasuries, right, and therefore the highest price in history, and those yields are negative, meaning that the buyer, if he holds the instrument to maturity, is guaranteed to lose money. And in addition to being guaranteed to lose money, right, and lending the U.S. government money for 30 years below the current rate of inflation, which historically is low, because normally the inflation is higher than this, and you would expect that over the next 30 years that the average rate of inflation would be higher than what it is right now. But in addition to that, in addition to accepting, a record low yield, you're accepting that yield when the U.S. government is in the worst financial shape it's ever been. Given that, right, the bond yields should be much higher, given the likelihood that either inflation will really go up in the future because we have to flate away debt that we can't repay, or we default because we can't pay and there's a restructuring or some kind of loss. But the fact that prices are so high, despite the fact that fundamentals are so low, is clear evidence, indisputable evidence, that the Treasury bond market is a bubble. Yet despite that undisputable, crystal clear evidence of a bubble, every person on that CNBC panel agreed that the Treasury bond market wasn't a bubble. Now, some of them said, well, we think the prices are a little high, but, it's kind of justified because people are looking for safe havens. And so they want to find a place to park their money that's safe. And so they're parking it in the safest asset there is, U.S. Treasuries. So therefore, it's not a bubble. But anybody buying U.S. Treasury bonds at the highest price in history with the lowest yield in history, when that yield is actually negative and you are guaranteed to lose money after inflation, anybody who is doing that, and on top of which the fiscal position of the United States has deteriorated so dramatically, and we have never been in this bad shape. In other words, our credit quality has never been this low. Anybody buying our debt at these prices thinking they're doing something safe is a complete fool. And that is exactly what defines a bubble. When people just do foolish things, they throw caution to the wind and they pile into a trade at the top. And again, maybe there's a little bit more to go to this insanity. But for these guys on CNBC not to see that this is a bubble is amazing. In fact, I don't think there's ever been a bubble that CNBC has been able to spot, whether it was the dot-com bubble in the 1990s or, the crypto bubble now. They cheerlead every single bubble that has ever inflated. Now, turning to the foreign exchange markets, the U.S. dollar finally had a down day. It had been on a bit of a tear. Today it was down about 50 basis points, just off the lows of the day. I think I saw it down a little over 60 basis points. The dollar index, though, still above 99.33, and it's still positive on the week. But one of the reasons that the dollar was down, and it was down before the economic data came out, but we got the PMI number, the composite number for February, and in January it was at 53.1, and the expectation was for a slight decline to 52.5. Well, we got a decline, but there was nothing slight about it. We plunged all the way down to 49.6, which is the first time that index has been in contraction in more than 6 years. Right? So this is supposedly the greatest economy ever, yet for the first time in 6 years, in the greatest economy ever, this PMI index shows that our economy is in fact contracting. And even more problematic is that the service sector is even weaker than manufacturing, which everybody thinks is completely immune. That one was supposed to go up. The service PMI was 53.2 in January, and that was supposed to notch up to 53.3. Instead, it collapsed all the way down to 49.4. Which is lower than the composite because it was weaker than manufacturing. So that is a big deal because the service sector is a much bigger part of U.S. GDP. In fact, Larry Kudlow was also on CNBC. Obviously, I spent a lot of time watching it today. That's where I get all this foolish information to work into my podcast. I get a lot of material there. But Kudlow was on talking about how great the economy is, talked about some of the economic data that came out yesterday that was a little bit better than expected, but not a word about the PMI numbers that came out today, even though he was on television a couple of hours after the numbers came out. They never even came up. All he talked about was this BS about how this is a booming economy, the greatest ever. It's, pure propaganda. So after this number came out, the dollar came into some additional selling. So there was some selling pressure on, and it went down. But the real big story is the gold market, which had been rising all week despite the rise in the dollar. Well, today, gold got a little bit of help from a weak dollar. In fact, at one point today, we were up almost $30 an ounce. We didn't close quite on the highs. I'm looking at the price right now, and we ended up about $23, $24, $16.42.50. We almost got up to $16.50 and a little bit of resistance there. My guess is we'll take that out next week, but we're now up 8%, maybe a little bit more on the price of gold so far this year. And finally, the gold stocks were showing a little bit of life. The GDX, which is an index of senior gold miners, that index was up a little bit more than 8% on the week. And the GDXJ was almost up 10% on the week. But still, these stocks are badly lagging where they should be, given how strong the gold market is. Because the GDXJ now year to date is also up about 8%. And the GDX is only up about 6%. So the junior mining stocks are about up the same percent as gold, and the seniors are up a smaller percent than the metal that they're mining. Now, this doesn't normally happen when gold's going up. I mentioned on an earlier podcast when gold prices were up 5.5% in January of 2016, gold stocks were up 20% that month. They were up about 3 times the increase in the price of gold. And in fact, if gold gets up to 1900, right, forget about 2000, right, which is the price target that I mentioned yesterday from Citibank. And by the way, Akash Doshi, who is the Citibank analyst, he actually called me up today, and I had a nice chat with him. And the reason he called, number one, is he wanted to thank me for mentioning his call on my podcast. He is a listener and has been for quite some time to my podcast. But he also wanted to correct a false impression that I had and that I gave to my listeners, which was that he just came up with that call yesterday, which is what I believed, and it's kind of how the CNBC crew presented it. In fact, he told me he was initially scheduled to be on CNBC yesterday to talk about that call, but because of the Morgan Stanley buyout of E-Trade, that kind of trumped his story, and so he got kicked off. And that's happened to me. That happens a lot when live news, some new news breaks, and you kind of redo your story for the day, and you change your guests around. But what he told me was that he actually made that $2,000 call, in that time horizon last year. So the price was quite a bit lower, and none of this coronavirus stuff was even happening before he made that $2,000 call. So he wanted me to know that he didn't just make the call, that he's had the call for a little while. And so I want everybody to know that and so that makes the call even more prescient. And by the way, I think he was, of all the analysts on Wall Street, he said that he won last year for being the best analyst on his prediction as to what the price of gold would do during 2019 was the closest to what it actually did. So he won as top analyst. So, kudos to him. But anyway, what I was saying was, if we just get up to 1900, forget about 2000, because I think 1900 was about the record high. We never actually made it to 2000. That's only about 15% from where we are now. But if you go back to gold stocks where they were the last time gold was 15% higher than it is now, they would have to double or more than double. So if we get a 15% move up in gold stocks have to go up about 7 times that amount to get back to where they were the last time gold's price was 15% higher than the current price. So this is still an incredible buying opportunity for gold stocks. I think people are completely clueless to what's going on. They're shell-shocked. They're not buying these stocks. One of these days, they're going to. And by the way, silver was only up about 16 cents today, so not a very big move. It's around $18.50 an ounce. So that thing hasn't even exploded yet. It will. So the silver stocks are not really participating. They're up a little bit, but it's the gold stocks that are getting all the interest because gold is the metal that is moving. But this is going to be a huge precious metal story, and it's not a short-term story. It's not just because of the coronavirus. The coronavirus has also been putting a bid in the dollar as people are mistaking that for a safe haven. That's actually been a headwind for gold. So had the dollar not been strengthening, had it been weakening, then the price of gold would probably be even higher. But as I said on yesterday's podcast, people need to buy these gold stocks. They did buy my gold fund, the Euro Pacific Gold Fund. Obviously, I'm biased. That's my fund. But I think I've got the best manager. I mean, I hired the guy to manage the portfolio. And by the way, I'm the biggest shareholder of my gold fund. And so I wanted to have the best manager managing my own money. And so that's Adrian Day. If I thought somebody else was better, I would have hired them. So I don't even think it's a biased opinion. So that's what people should be doing is buying my gold fund, but also buying physical gold. I thought it was funny. I put out some tweet today on gold, and of course I tweet about a lot of things. But I noticed one of the comments, somebody gets on there and says, oh, anybody who bought gold from Peter Schiff at any point has lost a fortune. They're missing out. They're losing a bunch of money. Don't listen to this guy. And it's like, what is he talking about? Who's lost money buying gold from me? I mean, yes, is it possible that some people who didn't buy any gold until 2011 or 12 or whatever it was at 1900, if that's the only gold they ever bought from me, and they never bought any earlier and they never bought any later, yeah, then I guess, there's a small percentage of people who are down, but that's not because they followed my advice, because I would have told those people to average down. And in fact, I probably was telling them to buy gold for years, and they waited for the absolute top before taking my advice and buying any of it. But if you go back to the beginning, I started recommending gold and selling gold actually to my clients, about 20 years ago. Gold was under $300 an ounce when I started selling physical gold to my clients. It's $16.40. How is that a bad thing? How have people lost money buying gold from me or buying gold because they heard me recommending it? When I first started gold, it was long before I started Schiff Gold. I didn't start Schiff Gold until about 2010-ish, I think. But I became a dealer with the Perth Mint in Australia. And I started selling the Perth Mint to my stock brokerage clients. And believe me, I had a big problem. The SEC came in and audited me, and they were going to charge me with selling unregistered securities. They said, hey, you're selling securities and they're not registered. And I said, these aren't securities. This is a receipt for storage of gold. And first they said, oh, we think they're securities. So I had to go hire a lawyer. I got a legal opinion. And eventually I was able to prove to the SEC that they weren't securities. They finally agreed with me after I spent a bunch of money on lawyers, right? They finally agreed with me, and then they let me off the hook, right? Because now they said, okay, I guess we were wrong. They're not unregistered securities, which they were not. But so I took a lot of flack from the regulators. But I really like that Perth Mint program, and they have an unallocated storage program where you can store gold, and there's no storage fee. The fee is zero. And I trust them. I mean, they're reinsured through Lloyd's of London. The Perth Mint is owned by the government of Australia. I think they're a very resource-friendly government, so I think it's one of the safer places. And I've always recommended that not only do people diversify in how they own gold, but to the extent that you're storing some gold, you should diversify where you store it. Just don't keep all your eggs in one basket. So keeping some of your gold eggs in the Perth Mint basket makes a lot of sense. So if you want to learn about the program, you talk to the brokers at Euro Pacific Capital. And, we're one of the only, in fact, we are the only Perth Mint dealer that can sell in California and a number of other states that are subject to the Model State Security Code. Other Perth Mint dealers legally can't sell in those states, but Euro Pacific Capital can. So if you have an account, talk to your broker or talk to Danny Dwyer at Euro Pacific, because it's just another way that you can own physical gold, as well as physical silver, physical platinum, just like you could buy gold from Schiff Gold and have it shipped to you. If you don't want to have to hold it personally, you want to have some in storage in a safe jurisdiction like Australia, you can have some physical gold at the Perth Mint. Speaking about physical gold, when I was at the Vancouver Resource Conference, I finally got my gold coin. Brett Johnson and I made a bet. I made a video about that bet a year ago. I bet that the next move by the Fed would be to cut rates, and Brett bet that the next move would be a rate hike. And we made that bet in early January of 2019. Of course, Brett was not alone. Pretty much everybody believed the Fed was going to hike rates. The question was how many times? Was it going to be 3 hikes? Was it going to be 4 hikes? And I was the only one on the panel, and probably the only one in the world, really, or one of the few people who said that they weren't going to hike at all. In fact, they were going to cut. And the moderator was like, so convinced I was wrong that he wanted me to bet Brett. Right. And he's obviously buddy with Brett. And he thought, hey, I'm going to give Brett some free money here by letting him take this sucker's bet here with Peter Schiff, because I'm going to put him on the spot because he made such a dumb comment. Right. How can anybody think the Fed is going to cut rates? So we bet a gold coin, and the Fed not only cut rates once, they cut rate 3 times. And so I won. And so this January in Vancouver, there was a panel, and Brett paid off the bet. And so I just put the video of that panel up on my YouTube channel today. So after you finish listening to this podcast, if you haven't already watched it, go and watch on YouTube that panel. But the interesting part about it is, so the resource conference, they initially put up the video on their site. That's how I get it. I'm just copying it off of their site. So when they initially put it up, I went to watch it. And I noticed that the panel discussion kind of started maybe about 3 or 4 minutes into the panel. And the entire part about the bet, where Brent pays me the coin, gives it to me, I take it, I put it in my pocket, we talk about the bet, why he lost, why I won, how I knew that the Fed was going to cut rates when everybody else thought they were going to hike. All that was missing. It had just been mysteriously cut out along with the introductions, and they just started the discussion after that whole part. And I'm like, wait a minute, that's very convenient. How could they cut out all that stuff? So I contacted them, and they found some of the missing footage, not all of it, but they found about 1:30 of footage that had been cut out. Now there's even more than that, and apparently they looked around for it, and mysteriously that footage is gone. But what I was able to do is I was able to put together at least some of the footage that is missing from the video on their site and put it on my site. But the other thing too, which is really funny, you get a kick out of it when you watch it, and this part is still up there, right? Although they cut it out on the official site, but it's on, it's part of the missing seconds that they gave me, and I made the longer one. But the moderator is so negative against me, and he's so biased, and you can see that. Go back and watch last year's panel in its entirety. The guy is totally anti-Peter Schiff, and he's totally on Brett's side. So the guy tries to pretend that I didn't win the bet, that Brett actually won the bet, even though he was wrong and I was right, and he gave me a gold coin. The guy's like, well, he didn't really lose, and he really got most of the bet right. And I mean, it's crazy. So you watch it, you'll get to see how this guy did not want to give me any credit for getting this thing right. I mean, what he should have said was, wow, Peter, that was a great call. I mean, nobody thought that. I mean, you really went on the limb, and, congratulations, you got that one right. You nailed it. No. He couldn't even bring himself to do that. So he had to pretend that the guy who lost the bet and had to pay me the gold coin, that he was actually the winner, and I still lost despite the fact that I got the coin. And, don't forget, while you're listening to other Peter Schiff videos or interviews, make sure and listen to Liz Claman's podcast. I mentioned it yesterday. Everyone talks to Liz. My most recent interview with her, that's her last podcast. I think they're really trying to promote it now over at Fox. I sent them some pictures that they want to use in their marketing. So look, they're going to try to push this. Let's help them. Let's give it a push ourselves. Again, I think it's a very entertaining interview. I listened to it myself. A lot of stuff that I said, I don't normally talk about. So, I'm not just, covering ground that you've heard many, many times. There's a lot of new stuff in there. So definitely listen to the Liz Claman podcast. And let's really help drive up the view counts or the listens on that to make this the #1 podcast that she's ever done. But I want to finish up the podcast, though, by kind of going over investment performance, particularly of my strategy, my managed accounts or my mutual funds. Can't really get into too many specifics because of the regulators, but I just really want to make an important point here about perspective, about having a view and the conviction to stand by it, and why you need to tune out a lot of noise, because in many cases the retail investor is his own worst enemy, because they act on emotion, they invest based on the rear view mirror, and they're not willing to follow an investment strategy to its conclusion if it doesn't immediately work out, right? And they're going to abandon it. And that's what's been happening. And I have been voicing my frustration on this podcast for years regarding Euro-Pacific clients who have thrown in the towel, right? I mean, that has been happening pretty consistently over the last 3 years. Now, I mean, during that time, our assets under management have gone up, right? So we have more funds that we're managing than we did 3 years ago, despite those outflows. And that's because the funds have been going up. So it's not like we've lost so much money that we're managing less, we're still managing more assets. It's just that we'd obviously have even more if those clients didn't make the mistake of pulling their money out. But, I'm not that upset personally. Sure, I'm going to earn a little less money because I'm not managing that money, but I don't care. I got plenty of money, and I'm my biggest client, and I'm doing great, I think, and I'm going to do even better in the future. But I feel very badly for these clients who have cashed out their accounts. And the reason I want to bring it up is I'm looking at one of the funds in particular, which is my value fund, Euro Pacific Value Fund. And that fund has done very, very poorly over the past 5 years. A lot of people on the internet, they want to give me shit about the fact that this fund has done so bad, right? Over the last 5 years, I'm in the 96th percentile. That means of the 253 funds that have been in this category, and the category is international large cap value. And of the 253 funds that have a 5-year track record, I'm in the bottom 4%, right? I'm stinking it up, right? I got 1 star. And over the last 3 years, almost as bad. I'm in the bottom 14%, right? I'm in the 86th percentile, and I got 2 stars. But still, I'm underperforming. And it doesn't take a lot, right? And these are the numbers as of yesterday. So the numbers are actually better today because I gained a lot of ground on the indexes and my category today. But even though I was in the bottom 14 percentile, I had only underperformed the category by 2.16% per year, and I'd underperformed the index by 1.7%. I mean, when you think about it, it's really not that much, so it doesn't take a lot to go from way underperforming to performing in line. And over the 5 years, I underperformed both the index and the category by 2.84% a year. Now, of course, over 5 years, that's about 12%. But again, I mean, it's not that much. And the reason there's such a small difference, between, the best fund and the worst fund is the vast majority of these funds are really just mimicking the index. I mean, everybody is afraid to take a view, right? Nobody wants to go out on the limb because they're worried they're going to get fired, right? So they don't want to perform that differently than the averages. Now, they want to try to do a little bit better. So they take whatever the weighting is and, they try to massage it slightly. So let's say something is weighted 10% in the index and they're really bullish on it. They might overweight it and go to like 11%, right? Have a little bit more, or underweight it, maybe go to 9%, but they're not going to get too far away in case they're wrong. And then, of course, what they might try to do is play around within the category. Maybe there's one particular company they think is a little bit better than another, so they'll have a little bit more of that one because they don't want to go too far from average, but they're hoping to be a little bit above so they can beat the benchmark, be higher in the category, right? But for me, that's never been my goal, right? I don't care about short-term performance. I care about absolute long-term performance. I have a view about what I think is going to happen. And people who share that view have sent me their money, whether it's a small portion of their money, a large portion, or all their money. It depends on how committed they are to that view. I mean, if they believe 100% that I'm right and they just want to bet the farm on it, then there are people who have done that. If they're just not even sure, if they just want to have a little bit of money with me in case I'm right, well, then they sent me that. But I'm managing money based on a particular outcome, a particular long-term global macro view. And in the interim, I don't really care how I perform relative to my competitors because I'm not going to fire myself. Now, the problem is my clients can fire me, and some of them have, or many of them have over the years, because they forget why they sent me their money in the first place. I've talked to a lot of clients, when they're closing their accounts. And by the way, I have called every single client personally who has closed an account with Euro Pacific Capital. Every single one of them. Even if I have never spoken to those people in the past, right? I talked to them. I gave them a call. And the goal, of course, was to try to convince them to hold on, right? Unless, They need it. Sometimes there's an emergency, somebody dies, somebody gets divorced, or there's an illness and they need the money, and this is the only place they can get it. So in that case, there's nothing to do. But I want to make sure that if somebody is closing their account because of past performance relative, let's say, to the US stock market, and they're just going to take the money and invest it in a different strategy, most likely in the US stock market, I want to talk some sense into that person. I want to try to save that person from themselves and prevent them from making a mistake, right? And some of the times I was successful, but many of the times I was not, and people ended up closing their accounts. But, a lot of the people had told me, I've been a big fan and a follower from a long time, and I listen to your podcast, and, I'm going to still listen to it, but I just can't wait any longer for the strategy to pay out, which never made sense to me, because if you still believe that I'm right, then what difference does it make how long you have to wait? If I'm right, then you're better safe than sorry. You better be prepared. You better be early. It's only if you think that I'm wrong that you should change strategies. But if you're telling me you're just tired of waiting, so what? Wait as long as it takes, right? If you believe in it, right? Because the alternative is a disaster. What if you bail out on my strategy and several years later, everything I was saying comes true and you end up broke instead of rich, right? So if you disagree with me, but of course I would always talk to the clients and remind them or ask them a question. Why did you start up your account with me in the first place? Whether it was 5 years ago, 8 years ago, 10 years ago, whatever, why did you send me the money? And it was always because, they shared my concerns. They were worried about the dollar. They were worried about the national debt, the U.S. economy, and the Fed. And I would point out that every single concern that they had initially is actually worse now, right? If things had changed, right? If, we had paid off a big chunk of the debt, if we were running budget surpluses, if we had entitlement reform and, we tackled this Social Security and Medicare problem, if we were having trade surpluses now, if the Fed had successfully normalized rates, right? If all this good stuff had happened, you could say, hey, Peter, I was worried about the U.S. economy, but it turned out that these guys made all these correct decisions and now the economy is on sounder footing and I'm no longer concerned. Oh, and by the way, I think the U.S. stock market represents a good investment value because, people didn't want to invest in the U.S. stock market when they sent me money because A, they thought it was overpriced, and B, they were worried about these problems. Well, the problems are much bigger now than they were then, and the market is even more overpriced now. So if you didn't want to buy U.S. stocks 5 years ago because you were worried about problems in the economy and you thought the market was too expensive, why would you want to buy them now when the problems in the economy are worse and the market is even more expensive? See, that's what happens in a mania because eventually even the people who were doubting it capitulate and throw in the towel and join the party. And it's always a mistake. But anyway, a lot of these people told me that they would continue to listen to my podcast. So this is for those people. But of course, everybody can benefit. But if you had an account at Euro Pacific Capital and you made the mistake of closing it in the last year, the last 2 years, the last 3 years, which is when everybody was doing it, you need to reverse that mistake and you need to get your money back before the mistake becomes even more costly. And here's why I want to point that out. So I'm talking about this value fund, right? So, and I'm looking at, these are yesterday's numbers, which are going to be even better after today's data is, because today is probably the biggest gap of outperformance. I think the fund was up about 1% today, my value fund, while the benchmark or the category is going to be down 0.5%. So I'm going to outperform by 150 basis points in a single day, right? Which is an incredible amount because that rarely happens because these funds are so similar to one another because, as I said, nobody wants to go out on a limb. So there's not that much difference between the funds, except there's a huge difference between my fund. So if you look at it, yesterday, my fund was the number one fund or in the top 1%, right? And the top 1%, there's 355 funds in the category now. So it's, 100 funds have added or so since 5 years ago. But the top 1% would be 3 funds, right? Well, my fund was in the top 1% yesterday, right? And it beat the category by about 0.7%. So I beat the category by about half as much as I beat it today. And I was still in the top 1% yesterday. So I'm clearly in the top 1% today. In fact, I think I'm the number one fund. I'm not just in the top 1%. I think I'm the best fund out of the 355. But not only was I in the number one category for day one, but for the week, I'm number one, and I will be number one for this week. I am number one for the month. I am number one for the past 3 months. And I am number one year to date, or in the top 1%. And if you go back an entire year, which is, 52 weeks, as of yesterday, I was in the top 16 percentile, which is pretty good, right? Top 16 percentile. As of today, my guess is I could be number one. We'll know tomorrow, but I think today's outperformance was so good that I could be number one. Now, at a minimum, I'm probably somewhere in the top 5 percentile or maybe higher, but there's a shot that I went all the way up to number one. But obviously, 3-year, 5-year, I am still badly lagging. But I believe, and again, this is just my belief, right? None of this is guaranteed by any means. I could be completely wrong. My fund could collapse. I could end up being the worst performing fund, right? But I think that by the end of this year, my fund, this fund, which was so bad, right, when the year started, right, the worst fund in the category, I think this fund is not only going to be number one for the year of 2020, I think it will be number one over the past 3 years and number one over the past 5 years. And I think Morningstar is going to have to go from a 1-star to a 5-star on this fund. Now, again, this is just what I think is going to happen because I think the trends that we're seeing now, the move up in gold stocks and the allocation or the shift from momentum to value is finally going to favor my strategy, which is so different than the average for this category. And I think all of the underperformance of the first 4 years will be completely made up in the 5th year. And so my point is, if that is the case, right? If my hunch turns out to be correct, and again, no guarantees, so I'm not guaranteeing anything. And if you're going to buy this fund, read the prospectus, make sure you understand all of the risks, right? But let's just, for the sake of argument, say that I am correct, because I could be, right? I could be right, could be wrong. But if I'm right, and if at the end of this year, and it could happen earlier, it could happen before the end of the 3rd quarter, but if I end up the number one fund over 5 years, does that mean that I was wrong to have recommended that people buy that fund 5 years ago? No. Does it mean that I did a bad job of managing it because I underperformed for the first 4 years and then killed it in the 5th? No, I mean, not if you held on to it for all 5 years, not if you were a long-term investor and you saw the strategy through. So it wasn't that I made a mistake in putting clients into the fund. It was that clients made a mistake of getting out of the fund, right? I might have put them in too early, but that wasn't a mistake if they ended up making money. The mistake was getting out too early and missing out on making the money. Now, you could certainly say that my advice wasn't perfect. I mean, obviously, I could have said buy something else. I could have said, hey, put all your money in a different fund or put all your money in the NASDAQ, which, of course, my clients didn't want to do, which is why they sent it to me. But now, with the benefit of hindsight, they kind of wish they had, and some of them want to blame me for that decision. But obviously, had I say, hey, let's be in this bubble for a while, and had I stayed in the U.S. markets or the NASDAQ, and then, a few months ago or whenever, put everybody into this fund, yes, that would have been better. But who the hell is going to do that? I mean, nobody expects perfection. If I am positioning people for a long-term outcome, then I'm a long-term investor. And as I said, I'd rather be early than late. I'd rather be safe than sorry. And so if it turns out that over the 5 years, right, that we end up number one, then it was right. And all of the clients that I worked so hard to keep from making a mistake, certainly for the ones where I was successful, then that's great. But more often than not, probably I ended up failing. But the point is that I made a bit earlier, if you're still listening to my podcast and you made the mistake of getting out, you can get back in. Because this is just the beginning, I think. I don't think I'm just going to outperform for 5 years going back. I think over 10 years, 5 years later, I'll be number one over a 10-year time period. I think my strategy is only now beginning to kick in. My strategy, had I had funds and managed accounts during the first decade of this century, I would have crushed it. From 2000 to 2010 was a fantastic time to be invested in commodities, gold, emerging markets, foreign currencies. They crushed the U.S. market during that decade. The next decade was a lousy year to be invested in those classes, and it was a great time to be invested in the U.S. stock market. Now, with the benefit of hindsight, we know that. I didn't know that in 2010, but I know it now, obviously. But I believe that this new decade is going to look a lot like the first decade of this century and nothing like the second. In fact, since the problems are much bigger now than they were in 2000, the bubble is much bigger. I think that the profits that people are going to make in gold stocks, emerging markets, foreign currencies, commodities, I think the profits are going to be even bigger. So I think we have a long way to go. So even if you're having to come back in and buy into my funds or some of these stocks at higher prices than you sold, it doesn't matter. Correct the mistake before it becomes a much, much bigger mistake. I mean, don't wait for my forecast of this fund being number one after 5 years. Don't wait for that to happen. Don't wait for the fund to have 5 stars before you buy it. Buy it while it still has 1 star, right? That's what the smart investors do. They buy what's undervalued and out of favor. Now, of course, I'm going to make a lot more money because once my fund has 5 stars, right, and it is number one, and people start looking back who didn't own it, they're going to say, whoa, I want to buy this fund. Look how well it's done, right? And, so that's going to happen, and that is going to benefit me as an asset manager because now all of a sudden a lot of money is going to start flowing into my funds from people who never even heard of me. All they're going to do is look at the track record and say, man, why didn't I own some of that? Why didn't my broker tell me to buy that? Look how good that fund has done. So that's what I think is coming. But again, that's for the regulators. That's my opinion, right? Read the prospectus. But anybody who owned my funds, right? If you sold them, they have loads. Some of them are no load at discount brokers, but at your Pacific Capital, right? If you bought the fund and you paid a load, you have a year to buy it back load free, no load. And, even if it's outside the year, I'll take it as a case by case basis. Probably, waive the load because I really want to make it easier for people to come back in. And so if that load is a barrier to entry, we'll see what we can do about it. If you were in one of my wrap accounts, right, we already waived the loads anyway. So it costs you nothing to invest in my wrap accounts. I mean, obviously the stocks that have done the best have been the gold stocks. So those are going to be the most expensive to buy back. But you know what? They're still cheap as far as I'm concerned. So the sooner you could buy them back, the better. But in my wrap accounts, there's no loads at all. If you had a separately managed account where I was managing a portfolio of stocks, remember in the managed accounts, we don't charge commissions. There are small transaction costs. They're not very high. So obviously we would have to incur those costs and pass them on to rebuy all the stocks that you sold. But do it. Fix your mistake, right? Admit to the mistake. Yes, sure. With the benefit of hindsight, I got people into my strategy too early. What can I do about it? I still feel confident that I did the right thing because I didn't lose faith in the strategy. I didn't give up. But what I'm suggesting is if you did give up, wake up. Look at what's happening. Everything that's happening is validating everything I was saying. And just because it's taking longer for the markets to validate it, just because the Fed was able to kick the can down the road for many, many years longer than we thought, and just because the bubble got bigger and fools, participated and greater fools kept getting greater and greater and greater, don't let that cloud your judgment. And see what's happening. Because a lot of people have always said, hey, Peter, what's going to happen? What's the bell that rings? It's ringing. So much stuff has happened recently, particularly last year with the Fed's about face and the aborting the attempt to normalize rates, the return to QE, even though they don't admit that they're doing it. Those were some very clear signals that everything I had been saying has been right. So you can't wait though, because by the time the markets validate everything that I've been saying, well, it's too late to invest in them. And the big things that really haven't happened yet, that are really going to show you that, the end is near, is when the bond market starts to fall. I mean, so far, the U.S. bond market is making new highs. People are still making the mistaken belief, right, that U.S. bonds are a safe haven. So the bond market is not collapsing. The dollar is not collapsing. And so that means you still have more time. How much time? I don't know. But the window will close because people are going to wake up. And once the dollar and the bond market start to fall together, and when that happens, the price of gold is going to be rising much faster than it is now. When that happens, it's, you don't have much time. I mean, you may not even have enough time. If you're going to wait for that signal, you probably waited too long, and there's going to be nothing that you can do. So before the bottom drops out of the U.S. bond market and the U.S. dollar, get your money back, reestablish your account at Euro Pacific Capital. And of course, if you've never had an account, open one up, right? I think we've gone past all the hard part, right? I think it's smooth sailing from here on in. I think we're going to see many, many years of phenomenal returns. And if you already have an account and you were smart enough not to close it, add to it. And in fact, the people who are the smartest are the ones who have been adding all along. In fact, let's say that my funds had been going up all along, right? So let's say instead of stinking for the first 4 years and then killing it in the 5th year, what if the funds just steadily rose? Well, anybody who was adding over time, right? Well, they're better off because we underperformed for the first 4 years, because that means as they were adding money, they were able to get more shares for their money. They were getting better prices on their stocks. They were getting better exchange rates. And so they have more money invested because the returns were back-end loaded. So it's actually a blessing in disguise. It's a gift horse that too many clients were looking in the mouth and turning down instead of just accepting it and taking advantage of it. But even if you haven't added, add now, because I still think we're very, very early. But again, I want to reiterate, just as a disclosure, right? I could be completely wrong. You could lose a bunch of money if I'm wrong. And so don't invest in any of my funds, my mutual funds, my managed accounts, unless you're prepared to lose money if I'm wrong. But if I'm right and you don't invest with me, you're also going to lose a lot of money. You're going to lose a fortune. Not only are you going to lose money, but the money you don't lose is going to lose a lot of its value if I'm right about the dollar. So there's risk no matter what you do. You just have to decide, use your mind and decide which risks you want to assume, and then, position your portfolio accordingly. So call up Euro Pacific Capital. Europac.com is the website, 800-727-7922. That is our 800 number if you don't know it. So give that a call, talk to your broker, and don't wait anymore, right? The longer you wait, I think, the more expensive it's going to be. And if you're correcting a mistake, the bigger the mistake's going to get, and the more it's going to cost you to make it right.